Good morning. Welcome to the morning market briefing. Today is Monday, the 1st of June. We are going to be talking about homes. Berkshire Hathaway and Timmeros actually had two articles today or over the weekend. He had one on Jay Powell and one on Kevin Warsh. So interested to hear Tom's thoughts about that. We also have Nvidia entering the Windows laptop market with its RTX Spark. So that'll be interesting to see the result. It's already having an impact on the markets, even though the launch isn't happening until the fall. So, Tom, let's just start off with this news. I know that Berkshire Hathaway has been famously sitting on a ton of cash for a long period of time now. And as a percentage of their cash holdings, this is actually very small. Berkshire Hathaway, it's around $1 trillion market capitalization right now. So buying a $6.8 billion home builder and incorporating it with its Clayton Homes business makes some sense, but maybe just get your thoughts on that. Is this a signal that this is the bottom in home building? And if so, why do you think they're making that call?
Well, I mean, notably, talk about small. They've been very famously sitting on more than $500 billion in treasuries for the last, year and a half. I mean, they've been cash super heavy as any entity that is not a government can be. So this is just a drop in the bucket. I mean, it's like 1.2% of their cash position. And I think this is a pretty traditional Berkshire move. There's blood in the streets. We've seen consistent signaling that this is the worst housing market, maybe in a decade, maybe 2 decades, since 2008. And now, the biggest value investor in the room is starting to make some moves. And it also, it lines up a lot with the other businesses they have. I mean, Berkshire Hathaway is big in insurance. They're big in real estate. They have a lot of synergies here where they can just, basically scoop this up. And I think they're not dumb. The Sun Belt is benefiting greatly from net migration, intrastate movements of people. I mean, we've seen all the numbers of who's moving to the Southeast. It's pretty much everybody from, California, Oregon, New York. We're seeing a huge population increase in the South and a decrease elsewhere. And that plays in their favor. There's eventually going to be a point where we see a hard stop on the fall of prices. We're going to see a hard stop on high interest rates. But we're probably not going to see a hard stop on things like wealth taxes in the state of Washington or continuing to, pick the pockets of people in New York City. And we're seeing things like property taxes and state income taxes be rolled out. I mean, Mississippi notably is going to eliminate their state income tax. Florida is working on not only not having a state income tax, but reducing property taxes as well. And net migration is going to benefit them greatly. And it'd be nice if you were the person who was building the homes in those areas and you got that for a pretty cheap valuation because the home building market is dead. I mean, I think that's the playbook here.
I think it's a classic value play. It's interesting. It's not a very moaty business. Historically, home building does not have a wide moat to it. It's kind of just a production business. There aren't really big barriers to entry. I don't really think of the brand of Taylor Morrison Homes as a defining brand. Apparently, it's a little bit of a premium to D.R. Horton, but I don't think really people care unless they own a Taylor Morrison home, and then they're going to say, well, Taylor Morrison Homes are very good. But if you're just someone on the street, you wouldn't know them from D.R. Horton or Lennar or KB Home or any of these other builders.
No, definitely not. But the thing is, Berkshire, they buy based on value. It's not like Geico doesn't compete, tooth and nail with State Farm, which is a big one, or, they own the majority stake in Pilot Flying J. It's not like there's not competition in gas stations, especially right now.
Yeah, that's a great point. For all the talk about moaty businesses, insurance is about the most commoditized, price sensitive. And I get Berkshire has a premium insurance business where it's very much relationship focused, but to your point, Geico is not.
Yeah, they have Berkshire Hathaway Realty. Their signs kind of were never anywhere, and now they're kind of always, especially around here. And that's a pretty commoditized business too. There's just they look for value. They don't really care that much about moat. There's a lot of talk about moat with Berkshire, and I don't necessarily think. Coca-Cola is one of the biggest. Amex. These are some of the most highly competitive industries in the world. Wells Fargo for a long time was a huge holding. I think they've since trimmed it a little bit, but I mean, these are not like just blow your mind investments. They just look for companies that are cheap, and then they start piling money into them until they're not cheap.
Yep.
And I mean, that's the playbook, and this really very much lines up into a traditional Berkshire investment in my mind.
Mm-hmm. Yeah, it's like the Warren Buffett in a bathtub situation, when he was thinking about buying Bank of America. He said, I just came up with this idea.
Yeah, I mean, listen, idea generation is the hardest part of this game, I think. So.
Yep. You mentioned, if the housing market hits a wall and how interest rates may affect that. Well, Nick Timiraos of the Wall Street Journal came out with profiles about both Jay Powell and Kevin Warsh over the weekend. With respect to Powell, he said, so Powell was recognized and accepted an award for political courage over the weekend. And so Timiraos summarized his remarks and basically said that although most of the speech dwelled on, quote, lofty civic themes, he did allude to the reason that he's actually staying on the board at the Fed. And he says, essentially, as soon as we get into a point where people are pushed out of the Fed, whether forcibly or just the amount of political pressure forces you out, then the Fed loses its power.
I mean, I would argue on the other hand, if you are in a position where you're being so political that you need to be forced out, then that's probably a problem too. I mean, that's, it kind of cuts both ways, but I don't know. Jay Powell has always wanted to be a hero. He's done a lot of work to try and position himself as a hero. And I think a lot of people think of him as a hero because he brought inflation down, but what really brought inflation down was the cessation of money printing. He was late, he was wrong, and then eventually it fixed itself. And he did raise interest rates, which needed to be done, but he did it at a pace that was agonizingly slow and then too fast. And then now he's positioning himself as a hero because he was wrong. Someone told him he was wrong and then said, hey, maybe you should stop being wrong. And he was like, well, I'm a hero of independence.
So do you think that he's getting this award for political courage because he cut rates last year or because he's not cutting rates when he's no longer chair?
Both. I think it's both. People forget they cut rates when inflation was net higher than it is right now, which somehow avoids all mention in the financial news media. But it was very conveniently right before an election where the economy was not showing real signs of life. As we recall, we called it the summer air pocket of 2023. I forget how long it's been. 24. Yeah. I don't know what day it is. It's Monday.
Kevin Warsh was also profiled, and he's talked about this before. He hasn't had any new comments, but Timiraos said, just be careful because Warsh is talking about not looking at core PCE or CPI and looking at kind of where the underlying inflation numbers are and kind of looking through some of the noise. And Timiraos warns about being careful about changing your metrics to something like a trimmed mean.
So the trimmed mean thing, I don't think really improves inflation because what you're ultimately trimming is inaccurate data. And so basically, here's the shorthand on a trimmed mean inflation, which is basically you look at the month over month, and it's like, this is a great example. Gas is up 20% month over month.
Airline fares up like 50%.
Yeah, and so what you do is you rank them all in order of change, so the biggest and the smallest. So something, say, I don't know, eggs went down 15% last month and gas went up 20. You just axe those out. And then you have a rolling inflation that has different things that are trimmed out, but they're the biggest changers up and down each month. And so the idea is that you're getting a smooth basket because ultimately the trims are going to be different in theory. Now, when the trims continue to be the same, say gas goes up 20% a month every month for 6 months, then the trim mean starts to become wildly inaccurate because people are going to feel that, and it's not going to be like, well, we eliminated that, so inflation is actually only 2. I don't know that fixes anything, really. I think that what would fix it is making sure the data you do have is accurate and up to date. And I think that's the biggest problem they have. So I don't know if we go from CPI to trimmed inflation, from course PCE, they all kind of say the same thing, which is that inflation is somewhere between 1 and 3, or 1 and 4, I suppose, at this point. But the problem is the biggest component is obviously wrong. It's so obviously wrong, I can't stress it enough. We talk about it every call, and that's the fact that somehow it's costing people 4% more, and housing prices are going up 4% year over year, according to CPI. But everywhere you look, housing prices are cratering, and the housing market is dead. And Berkshire Hathaway is making inroads into home building, which would indicate that they're very undervalued and maybe dead on the vine, and they're going to wait for them to come back. I mean, those are probably the biggest indicators you can find. Where is Warren Buffett buying, or his Greg Abel, the new guy? Where is Berkshire Hathaway buying? It's where things are really distressed and very out of favor. Home building, shocker. But I did read an interesting op-ed, and I, at the moment of failing to remember where it was, but it was saying that Kevin Warsh is a Trojan horse, is what this one kind of put in, where he wanted to usher in a Hamiltonian-style central bank. And the idea was that in the current era, where state inter-sovereign conflict at the economic level is so paramount, China's doing X, all these different, Europe is doing X, in order to benefit themselves on the world stage economically, we're in a position where we want our central bank to actually hamper us. We want to make sure that the central bank is working against the president. And that's the Jay Powell current method, is that we need to make sure that what he's trying to do to boost the economy has a big old blob of, I'll say, poop on its nose. You're going to make sure you just get right up underneath his nose, and he's going to feel bad about it every day. And the idea of a Hamiltonian central bank would be that the central bank is actually a tool to economically empower the state within it operates. So the Fed could be like, hey, how do we make America better than every single country by using monetary policy to benefit us and no one else? And then that was basically what the op-ed is that's what Kevin Warsh wants to do. And they're arguing that's not Fed independence. But what's more independent than having a company that can dominate other countries, because you're doing the correct monetary policy to make sure that you are at an economic advantage over all other countries. So it's an interesting thought experiment, or at least I guess it's an opinion. So what does that?
It is a bit of a
like?
Straw man too. I mean, I think that there is a massive difference between having a central bank that promotes, how the country operates, and a central bank that tries to foment competition with other countries, because then you do get into currency manipulation and things like that, which could hinder the dollar status. And
I think the happy medium is somewhere in between.
Yeah,
and that's the thing. I was listening to a podcast. It was actually about demographic decline and birth rates, but this insane woman who is ultra pro-natalist. This is what I listen to in my free time. Was saying that, contrary to what you hear, the U.S. is actually an insane socialist utopia. We've actually taken the best parts of socialism and we've attached them to the best parts of capitalism, and that's why we can't have birth rates decline, because it's just an insane socialist Ponzi scheme where it's we've used capitalism to gain so much wealth that we can then pay out all this wealth to so many people. And now we're doing it at a level where we're importing people just to pay it out to them. And if we have massive population decline, that all ends, and the utopia goes away. And so what we need is more people, more innovation all the time. But if you have fewer people and fewer younger people, then the incentive to innovate declines, because you look around at ChatGPT, you look around at anything, young people are the people who want new stuff. Old people are actually the people who don't want new stuff. So if you start to get into a situation where you have no young people and a rapidly growing old people population, the desire for innovation dies, and the desire for innovation drives this whole socialist utopia. It was a wild argument. This lady was a little intense, and if I could show you a picture of her, you'd be like, yeah, this lady has some hardline opinions.
The good news is,
but it was an interesting, we do live in a socialist utopia. This is the best version of that you can get. China is not it. Cuba certainly is not it. So like, hey, let's just focus on the idea that like some of your ideas work and we're glad to have them, but the idea that we need to not have children, that the earth is going to light on fire, we're all going to die. It's actually not true. We're actually going to run out of people and the earth is going to probably have too much CO2 or too many trees here in the next 50 years. So let's all chill on that stuff. It was an interesting podcast though. Go ahead, Ben. Sorry.
I have many comments, but I'll save them for the. We should do like a show which is just kind of on a different channel, but just kind of is like either the pre-market the pre-call show or the post-call show, because there's a lot of material there. I was thinking about this a lot this weekend. It's not on the agenda, but kind of going on from our Fed discussion, I would say that the Fed's quantitative tightening and rate increases have taken money supply out of the market and has really caused some significant impacts in the economy. Would that be fair?
Yes.
And so their balance sheet has come down by about $2.5, maybe $3 trillion over the last couple of years. I was thinking about this, and this is in the most liquid market in the world in short-term treasuries. Bigger than equities, bigger than anything. And then I was thinking, you were about to dump $2 trillion worth of new stock onto the market in the form of SpaceX shares. And I've been thinking to myself, this is going to be, you're going to need a lot of liquidity to eat this up. And it's just something that I'm continuing to consider, and it's going to be very interesting because I know that we spoke about this last week, but more information's kind of come to light, and I've done a little bit more work on this, but they've waived a lot of the rules that would mandate, S&P 500 inclusion, Russell 1000 inclusion. Usually you have to show profitability for 4 consecutive quarters on a GAAP basis. They've waived that. SpaceX loses money, so they would not have been in. And you also have to be publicly traded for at least a year, and they've waived that as well. And so Standard & Poor's S&P 500 is going to have to buy the stock. All these index funds are going to have to buy the stock. Russell, any small cap, any Russell 3000 index is going to have to buy the stock.
Broad market index.
And so anyone who owns an S&P 500 index fund will now have, I don't know, call it about 3 or 4% of their portfolio, maybe, probably closer to 4% of your portfolio in SpaceX shares, which is very, I don't know, it makes me think. I don't have firm conviction on it right now, but it does make you think.
What's concerning is that there's only 100% of any of these indices, be it Russell 1000 or Wilshire 5000 or the S&P 500. And this is going to be one of the biggest components because most of those are value weighted, market cap weighted. So if you have to squeeze 3% out of the S&P 500, where does it come from? And there's still going to be 500 companies. I think it's actually 502 because Google is in there, but like still, I mean, does it mean that Starbucks goes from being 60 bips to being 40 bips? I mean, where does it come from? It's going to squeeze somewhere, and they're going to be systematically required to sell that 3% of something to buy the 3% of SpaceX. And the question is, where does it come from? Or does it come from everywhere? I mean, and in theory, the biggest companies are going to get trimmed the most in terms of total valuation because that's where most of the money is. So if you're squeezing out, I mean, it's going to draw Nvidia from say 8.5, 9,
8.5 to 8.
Call it to 8, but 50 basis points of Nvidia in every single ETF mutual fund portfolio on the planet is going to be a lot of selling. I mean, it's a lot of selling. It could be in the hundreds of billions of dollars day one. I mean, and that's going to be true of Apple. It's going to be true of Amazon. It's going to be true of Tesla as well. Though there are rumors that they're going to merge Tesla in there eventually and make their super robot space dreams come true. So yeah, I don't know what that looks like, but it could get very, very choppy. Though you could argue the offset of everyone having to buy SpaceX and you actually own it too is going to push SpaceX to the moon, pun intended. So we'll see. I mean, it's really, or does just the more money come off the sidelines because we have all those
I think
all that cash.
I think that's got to be the bull narrative, is that money comes off the sidelines to absorb that. I think, though, it's essentially going to be a dilution because you're adding so much market cap and you're adding net losses to the S&P 500. So the S&P 500 valuation is going to go up, call it a point. Like if we're at 20 times earnings, we'll go to 21 times earnings. If we're at 22 times earnings, we go to 23 times earnings. It just gets more expensive as a basket.
Counterpoint, those people who are getting liquidation events are suddenly going to go from paper billionaires, some super billionaires, to cash money operators. I mean, it's like man, on paper, I've got $1 billion in SpaceX stock. Yep. What can I do with that? Nothing. Well, but suddenly you can do something, and that's going to be a real driver as well.
And I think that's the way to think about it too. I mean, I think you got to think these people aren't just going to continue to hold SpaceX shares. I mean, they've taken a salary for the last 10, 15, 20 years, and now they're worth $80 million. They're going to take a large chunk of that and go buy a yacht.
Man, they could go buy a house in the Sun Belt where, I don't know, SpaceX is located. Suddenly you're going to have a bunch of big ballers building big houses, and maybe Taylor Morrison's going to build them, and Berkshire Hathaway is going to pocket the difference. I mean, there's so many unknowns, but what we do know is there's going to be a massive wealth creation event that is going to flow in directly into the S&P 500 that may cause some wild gyrations because it's such a mass like creation of wealth, but it's going to be transferred to public shareholders and away from private shareholders.
How many mailings do you think SpaceX employees are getting from Restoration Hardware right now?
Oh, I mean, I've been getting these
a short list
suggested posts on LinkedIn from a guy who's a SpaceX shareholder specialist financial advisor, and it's like, okay, so what do you do a year from now? I mean, he's trying to position himself as being
an open AI specialist.
Yeah. And even if he gets one, that's a good book of business probably. So interesting.
Nvidia is entering the Windows laptop game, coming out with an RTX Spark Superchip. You said you wanted one, Tom, for your work machine. Nvidia shares are up 2% pre-market, but Intel down 6%, Qualcomm down 9%, AMD down 5%, all getting hit. In its most recent conference call, Nvidia did say that they want to be a market leader in CPUs. Expect to be, I thought that was kind of meaning for the data center, but now they're going to go to consumer devices. So this is interesting. You see a convergence here of the GPU space and that technology with the traditional CPU space.
I would say that I would call my barely works machine. But it's an interesting thought because if you think of like Meta as a company, what they've quietly done over time is mimicked other technologies, and then the ones they think are going to be, or the sharks closest to the boat, they buy. And then they start dominating that space. I mean, think Instagram, think Snapchat, all these different things that there's suddenly a new version of what they do. They can just buy them up or compete directly with them and put them out of business or make them irrelevant. Now, Nvidia now has the fattest stack of chips at the poker table. They can start going after every other tech company. It's like, we make these chips and they go into Microsoft computers. Well, guess what? We've got more money sitting in our garage than Microsoft has, and we can start making our own computers. And guess what? We can start to vertically integrate across the entire tech space. I mean, it could be that Jensen Huang, who presents himself as this nice guy. I used to scrub toilets in boarding school, yada, yada, yada. Suddenly there could only be one company, and who's going to stop him? Nobody. He's got more money than you do. And everyone combined. I mean, it's kind of an interesting thought.
Between Warren Buffett, Greg Abel at Berkshire Hathaway, and Jensen Huang today at Nvidia, it's like these guys are absolute killers, but they come off the nicest guys in the world.
I mean, did you see the Wall Street Journal hit piece on Bill Gates?
Yeah, saying
that they basically worked as hard as they could to make him seem like a real nice guy, and it turns out he was an absolute scumbag. I mean, who's to say which one of these guys? I mean, like Zuckerberg, I think does a bad job at hiding it, and everybody kind of knows. But which of these guys could be that guy? I guess we'll find out. But Jensen Huang, I mean, universally celebrated that guy. Perhaps he could, at a certain time, Bill Gates was the big tech guy who was universally celebrated and wore glasses and a goofy leather jacket, and then we found out he was a scumbag. So who knows? I mean, everything's on the table. You know, we only know what we know, and there's plenty of discussions behind closed doors, I'm sure.
ISM Manufacturing today. We'll be watching that and give you a report tomorrow. With that, have a great day, and we'll see you tomorrow. Bye.